people say we're always bearish. That's not actually true, but we're almost invariably skeptical. We want doubting Thomases. This is a market of credulity and conformity, actually. Nothing succeeds like success anywhere, but especially on Wall Street. I think it was George Soros himself said, when we see a bubble, just jump on it, get there early, and you will get it in time. I'll tell you when, you'll know. But there are so many ways to make money on Wall Street. I happen to have cultivated a following that is innately skeptical.
Before we dive into the video, if you've been enjoying the show, be sure to click the subscribe button below so you never miss an episode. It's a free and easy way to support us, and we'd really appreciate it. Thank you so much.
Hi, everyone. I'm delighted to be back with you again on the Richer, Wiser, Happier podcast. Today's episode is an important, timely, and extremely thought-provoking conversation with Jim Grant. Jim, who's a cult figure in elite investment circles, is the renowned founder and editor of Grant's Interest Rate Observer, a bi-weekly publication that he's edited since 1983. These days, it costs the best part of $2,000 a year for a subscription, so it's not cheap, but it's widely recognized as an invaluable source of unconventional insights for sophisticated investors. Nassim Taleb, who's not an easy man to impress, has written that Jim Grant thinks outside the box. Please read him. Listen to him. David Swenson, who ran Yale University's endowment with huge success for decades, once remarked that Grant's Interest Rate Observer is on the must-read list of every serious student of markets. One reason for Jim's stellar reputation is that he draws deeply on his knowledge of financial history to issue early warnings about brewing storms that many investors fail to recognize until it's too late. He's never been afraid to point out the wretched excesses of Wall Street, those moments when speculative fads get out of hand and when unscrupulous investment firms are selling dross that's dangerous to the financial health of careless or credulous investors. In 1999, for example, at the height of the dotcom bubble, Jim warned that it was one of the most perilous periods in investment history and that America was dangling by a thread, financially speaking. A few years later, he was one of the first people to warn about the dangerous mortgage securities that led to catastrophe in the global financial crisis of 2008-9. In the years after the financial crisis, he presciently warned that the Federal Reserve's monetary policies would inevitably spark runaway inflation. So what's Jim saying today? Well, as you're about to hear, he argues quite forcefully that prudent investors would be wise to exercise considerable caution at the moment, given the heightened risks and speculative behavior that he's observing. As Jim sees it at this point in October 2025, there are many unsettling symptoms of euphoria, recklessness, folly, and corruption in financial markets these days, all of which he sees as potential warning signs of what he calls a major market top. Now, the reality is, I have no idea if Jim's right, and he's not sure either. After all, markets are inherently unpredictable, and it's also more or less impossible to get the timing right, even if you're smart enough or lucky enough to predict a major shift in market sentiment. This reminds me of a discussion I had with Howard Marks in Chapter 3 of my book, Richer, Wiser, Happier. Howard told me, I don't even think about the timing. In the investment business, it's very hard to do the right thing, he said, and it's impossible to do the right thing at the right time. That said, I think it's well worth listening when someone as shrewd and seasoned as Jim Grant warns that we should be treading with extra care. At the very least, it's worth asking yourself if you're overexposed to risks that you can't afford to be taking. As Howard Marks said to me, it's not about selling everything and suddenly going to cash. It's more about preparing for an uncertain future by asking yourself if you're pushing the envelope too far. For example, if you have too much debt or leverage, or if too much of your money is tied up in speculative assets that might be dangerously overvalued. For battle-hardened survivors like Jim and Howard, I think one of the great lessons of financial history is that reckless excess and overconfidence is eventually punished. So it's important not to get too carried away during outbreaks of what seem to be irrational exuberance. On an entirely different note, I also wanted to take this opportunity to let you know that I'm launching a new Richer, Wiser, Happier Masterclass on November 21st. This is a chance to study directly with me over the course of a year as part of a very small group that's capped at a maximum of 20 people. We'll meet once a month over Zoom and also at a couple of unique in-person events. Last year, the Masterclass drew an incredibly accomplished group of 20 people from, I think, 7 different countries, including some very successful hedge fund managers, wealth advisors, asset allocators, managers of single-family offices, CEOs, and entrepreneurs. The people who've signed up for the new masterclass are equally impressive, and we only have a few spots left. So if you are interested, please do email my friend and fellow podcast host, Kyle Grieve, as soon as possible, and he can send you more details. His email address is Kyle, that's Kyle, at theinvestorspodcast.com. The masterclass is designed specifically for people who are serious investors and passionate learners and who are really looking to build lives that are truly richer, wiser, and happier. So if that sounds like you, I'd love to hear from you and would be thrilled to have the opportunity to study with you over the coming year. And now, back to the show. Hi, folks. I'm absolutely thrilled to welcome back the great Jim Grant to the Richer, Wiser, Happier podcast. Jim, as you all know, is a brilliant financial historian and a wonderful writer and speaker, and also the editor of Grant's Interest Rate Observer, which he founded 42 or so years ago. And it's a must-read publication for the most sophisticated and well-heeled professional investors, probably because it's so expensive, but also because it's so good.
Cheap at the price.
Cheap at the price, exactly. Every time I think about getting my subscription, you put up the price again and I blanch again, but I'm finally going to stop.
That's the business plan.
It's very wise, but it's a wonderful publication.
You're an aspirational subscriber. We have many of them.
Thank you so much for joining us again, Jim. It's a real pleasure to see you.
It's a delight to be here.
Thank you. And well, as Charlie Munger would say, he said it's a delight to be anywhere. He was just glad still to be around for as long as he was. So anyway, I'm happy to be with you. And I attended your wonderful annual fall conference yesterday.
I know. I was so very pleased to see your familiar and shining and welcoming and encouraging face in the audience.
Oh, it was great. And for people who don't know, this is a very glamorous affair at the Plaza Hotel in New York City, and it attracts many of the smartest and wisest people in the investment world, not only as speakers, but actually as audience members. And you said just before we started that you wanted to tell a story about something that came up at the end of the conference. Tell us. I have no idea what this is about.
I hope I'm not being indiscreet, although what is journalism for except indiscretion? You're with me?
Exactly. Yeah.
This comes from David Rosenthal, who was a speaker at the conference. And David is the number 4 hire at NVIDIA. And how is that for a credential life? He's he's a gifted computer scientist. I can't imagine what computer science is not gifted in many departments of mental acuity. But David is a standout even in that rather formidable crowd. Anyway, this story has to do with a kind of reunion of founding employees of NVIDIA. And I guess it was fairly recently, and it takes place at an ethnic restaurant. I call it a Salvadorian cooking. And there are tables full of NVIDIA employees then and now. And Jensen Huang, the storied CEO, gets up and announces to the crowd, I'm pretty good at fundraising. And what I want you to do, ladies and gentlemen, is empty your wallets and give me your cash. They complied, as well one might, presence of the CEO and his colleagues. CEO Jensen collects all this money. And interestingly, for a Silicon Valley crowd, there's people carrying a lot of cash. And so he has a big wad of bills, and he walks over to the proprietor of this not 4-star restaurant. And so we here know a little bit about how difficult it was to start a business up. I want you to take this. Delightful.
Wow.
Isn't that something?
That's really nice.
Yeah. Shouldn't we all do that once in our lives?
We should. I thought, for me, the moment you mentioned David Rosenthal, what comes to mind to me is he gave a presentation that I think I only understood about 1 in 5 words because it was deeply technical. But what did you make of it? That he seemed to be dismantling the idea that Bitcoin was as safe and private as people imagine. And he's obviously
Correct.
a very gifted computer scientist who has many patents. And as he put it, not only was he the fourth employee at NVIDIA, but actually, given that there were 3 co-founders, he was actually the first hire. So this is a very smart guy. And he was saying that basically, as I understand it, that once we get further along with quantum computing, I think he said there are about 20% of the Bitcoins out there are sort of lost or unclaimed, that people have lost their keys or they're in trash piles or whatever, and that a quantum computer might be able to actually relatively quickly figure out how to claim for oneself that missing crypto. What did you make of that? This is way above my pay grade.
Yeah, that's exactly the message, I think. As you say, it was deeply technical, certainly over my head in many places. But he was attacking the pretensions of the technologically sophisticated who contended that Bitcoin was useful and safe and somehow inured from infiltration by the likes of the coming quantum computers. He's trying to explode that, which I gather he did.
And I think there's a link to this on his blog, which I'll try to remember to include on the show notes for this episode so that people can actually track this down.
Something much more accessible. I bet this is up on his blog. I don't know. There's a talk that David Rosenthal gave to a class at Stanford University, I think it was electrical engineering, in 2021. He was filling in for a professor. It's the most lucid attack on Bitcoin. I read it. I thought to myself, why isn't this fraud trading at 0? It did not go to 0. So maybe people know something that and even David doesn't know about Bitcoin. But I thought he made a very good set of close arguments. He winds up and says, rarely if ever in the annals of technology have the champions of a breakthrough technology gone to such pains to not use it. So he was questioning the utility of it. So you kind of had to be there for that one. And not only did you have to be there, you had to understand much more of the technical issues than I do. And your summary got most of it.
This is a very familiar feeling to me in the financial and technology world, that I'm with people who are much smarter than I am, and I'm picking up crumbs as they fall from the table.
I don't think smart is, I think familiar or trained or something, but no doubt every field has its vocabulary. I mean, we are all humbled in the presence of astronomers, for example.
Yeah. While we're at it, we should close this subject of cryptocurrencies, because this wasn't in any way where I was intending to go at the start of our conversation. But since we're here, I'll ride this horse that we're on. But you spoke at the conference of the pretense of things that are not money posing as such. It's fair to say, if people listen to our last interview on the podcast 3 years ago, we talked about crypto in some depth. And Bitcoin now, I think, is around $116,000 per coin as we speak, despite a recent sell-off. You've written quite a lot about, as you call it, a crypto-besotted Wall Street that's driven up valuations, so that there's now, I think, more than $4 trillion in aggregate value of all cryptocurrencies. And I read on Bloomberg the other day that Bitcoin ETFs now manage more than $142 billion, and that even Vanguard is now weighing the possibility of allowing its 50 million or so clients to trade crypto ETFs, whether it's Bitcoin or Ether or whatever. Jack Bogle, the founder of Vanguard, had famously warned investors to avoid Bitcoin like the plague. And so I'm just wondering what you make of what we're seeing here. Is this just standard top of the cycle recklessness and folly, or is this, you've been following this world of finance for quite a long time. When you look at this phenomenon, what does it mean?
Well, one is forever humbled by the markets, the ways and wiles of the market. I still don't understand what people see in it. Maybe there's a divide of some kind of limbic system divide that people say, oh, yes, Bitcoin. I want some of that. For the price of a house, what is it? Can you see it? No, you can't see it. Now, what are you going to use it for? What's its functionality? Well, I'm not so sure about that, but it has done well, hasn't it? Yeah. So I am no longer on certain cable TV stations that I used to be on regularly. I humor myself, or I try to comfort myself by saying it's not age. It's not the overfamiliarity with the arguments that fall from my lips. No, it is my anti-MAGA country club Republican mind that grants. And it is also the last words that I spoke on this particular cable channel. When asked about Bitcoin, I said the most efficient price is zero. And my God, this administration is all in on crypto. It's the scammiest thing, the connection between Bitcoin and the Bitcoin promoters and the president and his family and these coins. And it began before his inauguration. We had issued this Trump coin, and it was kind of a rug pull thing. And I think it's shocking and contemptible. But these cryptos are being heavily promoted by the administration, both overtly and indirectly by the regulatory approach it has taken toward them. Now, as to Wall Street, it's monkey see, monkey do, especially when that monkey is moving upward and to the right, a stock chart. Bitcoin's genesis was in pseudonymous, right?
Yeah.
Not anonymous, yes. So you could go and procure whatever you wanted to, whether it was drugs and surface-to-air missiles, or if you were living in a united country that would allow you to take money out, you can take your money out through Bitcoin. It's no awesome. But in any case, it was off the grid and outside the pale of conventional Wall Street. Now look, Vanguard, for Pete's sake, it's right down the middle of the fairway. So the establishment, which could not abide it, couldn't stand it. Oh, God. Now it's, Bitcoin, it's a thing. Let's start the next ETF. So I still think the most efficient price of Bitcoin is zero.
Well, that's good. So now that we've very efficiently offended half our audience in the first 10 minutes, either politically or financially, we can be much...
Let's get the other half.
Let's get the other half.
The other half.
By the time we come around to talking about your book in an hour or so, nobody will be left except for my mother.
Well, they should buy the book. They should buy the book, right?
I bought the book, and I very much enjoyed it. Although I have to say it's 400 and something pages long, and I'm about 20 pages from the end. So I'm ashamed that I didn't quite finish it last night.
I'm not going to tell you how it wound up.
Did it all end happily, like most of history? So anyway, we'll get to the book later. But the thing that I wanted to start talking to you about, except for the fact that both of us digressed for 15 minutes to insult half the country, is I found yesterday your conference, it was a fascinating day and also a slightly unsettling day. And what struck me, I think, was the divergence between the current mood of euphoria in the markets and the acute skepticism and wariness in the room among your speakers, who are a savvy, battle-hardened bunch. And so, for example, there was a credit investor named Victor Kozler, who manages something like $22 billion, who said markets are very bubbly and there are lots of problems under the surface. So, for example, he said there are entire areas of private equity that are in deep trouble and lots of companies within private equity that are defaulting on their debt and going bankrupt. Can you give us a sense, for people who weren't at the conference, of the mood there and what it reflects about the financial environment today?
Well,
because
yes. I'll be happy to. For the listeners, you have to understand that it was a self-selected group of people, and Grants has made its living those 42 odd years. And were yes, but people who are in gee whiz world. People say we're always bearish. That's not actually true, but we are almost invariably skeptical. We want doubting Thomases. This is a market of credulity and conformity, actually. Nothing succeeds like success anywhere, but especially at Wall Street. I think it was George Soros himself said, we'll see a bubble, just jump on it, get there early, and you will get it in time. I'll tell you when, you'll know. But there are so many ways to make money on Wall Street. I happen to have cultivated a following that is innately skeptical. And so bear that in mind, and we take away. People walk out of these conferences saying, oh my God, how can I get up tomorrow morning?
Yeah, I felt I should go in fetal position in the bathroom at lunchtime.
It was a good fair mix of people. For example, even within credit, you mentioned Victor Kozler and a guy named Jonathan Lewinson of Diameter Capital Management, who rather said, well, things aren't so bad. Look at this. Those things are much better than you'd think by looking at a few soft spots. So there was disagreement. And John Hughes talked about investing in great companies and not selling them. So it's a fair. So that speaks to the variety of ways in which people of different sensibilities and different intellectual turns, or different turns of mind, can find a place under the big tent of investing. It's nice in that way, isn't it? And we had innate Kapakar, we had the pure specimen of the bear. To me, it's a very fetching mindset. He's a perfect example of an avatar of the sell first, buy later approach to securities trading, and investment. He exhibited the rueful humor of someone who was prepared to be wrong about 90% of the time in anticipation of being magnificently and all by himself, magnificently right 6 or 8 or 10% of the time.
Yeah, he said something lovely about how you asked him impertinently in the way that only a journalist can, why do you do this? Sort of an existential question about being a short seller. And he said, well, for the 15 minutes, when you're right, it's so delicious. It just made me think some people really, they're so smart and they make life very, very difficult for themselves by picking a particularly hard way to play the game of investing.
Yeah, he's chosen the highest degree of difficulty. And there aren't many left. These markets run over the skeptical mind. You say, well, have you read the documents? What's the valuation? It's going up. That's the valuation. So Nate, his talk had to do with private equity and with AI and all the privates, private credit. You think be a sergeant or least or a corporal or this mix, but no, it's all privates. And he pointed out it was a magnificent tour de force and tour of the horizon. What's wrong in finance, having to do with the structure of things, with the underlying fragility of debt, and with the consequences of all those years of suppressed rates of interest, which of course interests me. And so I'm still sore that interest rates were not a thing for so many years. Publication, ladies and gentlemen, it's called Grant's Interest Rate Observer. If you can't see them, it's not good for business. So I'm still nursing a grudge against the Fed for that.
But now you have your 15 minutes, so all is well for you and Nate. He also pointed out, I think it was in his talk, one of the most striking things that was a recurring theme that I think is relevant to a fair number of our listeners is that we should be deeply skeptical of the world of private equity as they try to democratize it. And I think it was Nate Kopakar said that in finance, whenever you hear the word democratizing, hide your wallet. And he said it's like Chanel marketing itself to Walmart. Can you talk about that? Because that seems like a really beautiful example of this ebullient time where Wall Street is dreaming up new and better ways to separate us from our money.
Well, the hypocrisy is delicious. As Nate to put it, private equity people at first did everything they could to distance themselves from the common man. Their shoes were bespoke, their suits magnificent. Their club memberships extensive, and they would deal with the institutional world and not all of that. And lo and behold, interest rates did not remain at near zero after 2021. And the valuations that were acceptable in a regime of like nothing interest rates suddenly became very precarious. Indeed, those valuations went away at a time when rates kind of began to normalize. So these companies, these private equity companies, 20-something thousand of them in the world, were capitalized for prosperity and, more meaningfully, capitalized for a regime of very, very easy money. So suddenly, instead of paying, say 3% interest on their debt, they were now paying 8% or 10 or 12. Makes a difference. So what to do? Well, the investors, and they're not just well-to-do endowments. Well, their endowments were among the elite institutions to which the private equity people sold. So they would go around to mimicking the famous Yale University model of
David Swenson. Yeah.
Yeah, David. And they go around to these endowments, colleges, what have you, and saying Yale did this. And what it did was to carve out a very big niche in its portfolio for venture capital and private equity. And you won't be susceptible to adverse marks that reflect the unreasoned volatility of public markets. Rather, the marks that they give you are virtually correct. And marks, meaning mark to market or not. So not.
Not marks as in the sense of a Ponzi scheme where you've identified marks.
Yes, right. Yes. I did ask Nate about Ponzi schemes. And he said that the term seemed it seemed unnecessarily brutal for this sophisticated audience. So private equity sold overwhelmingly to such institutions. And now such institutions, having budgeted for return of their capital, are finding that it's not being returned, nor are the dividends or the interim payments they'd expected quite up to snuff. So they are being pressed by the presidents of colleges and eleemosynary institutions, museums, what have you, to where exactly is the money we need for the draw this year, draw on the endowment funds. And they're hard pressed to come up with the money. So some of them are turning to the secondary market for shares and these private equity companies. They're being peeled off and sold like you sell a used car. And it's not what the buyers originally counted on. So private equity, I think, that may demonstrate is in trouble. And it's in trouble because it has neglected to honestly value its assets as interest rates began, and now it's stuck with assets that are being carried at unreasonably high prices, and the assets are not returning the cash that the investors need. So what to do? I know. The dear public, hence the long time to get to this. So this is where democratization comes in. Shouldn't the little guy have a piece of this marvelous asset class, private credit, private equity? Credit, by the way, has none of the overtones of debt. It's kind of the same thing, private debt, meaning not publicly traded, so not publicly market. And you can see it in the unwavering line of capital appreciation with these funds and these assets have delivered to investors, supposedly. Anyway, it's being marketed to the public as a safe and non-ulcer-inducing alternative to sometimes tumultuous public markets. Nate correctly says, I think, that this is not a sign of benevolence of the promoters, but rather a sign of their increasing desperation.
I think it was also interesting that he said that they have this reputation for being super sophisticated. And obviously, in some cases, they really are super sophisticated. But he said, when you look at the record of many private equity firms, they've shown, as he put it, maximum aggression at periods of maximum risk. And so he said, really, they have a tremendous record of momentum chasing. And so for me, it was kind of a reminder that often we fall for the illusion that the smart money is incredibly smart and way smarter than us and is going to protect us from turmoil that can come.
Yes, well, in the audience was my friend Emmanuel Dermot. Emmanuel Dermot is a Bell Labs caliber physicist who made a career change to Wall Street, became a renowned practitioner of quantitative finance. We call them quants, of course. And he worked at Goldman Sachs for a time and other such high-ranked institutions in the Wall Street league tables. He wrote a book called My Life as a Quant, a great memoir. Never mind my book by David Emmanuel Derman's book that was published in 2003 or 4. My Life as a Quant. Anyway, at one point, Emmanuel harks back to the long-term capital management affair, 1997, I think. Anyway, it was the now fabled, then frightening collapse of a hedge fund that was run literally by Nobel laureates. And in his memoir, Emmanuel Dermot says that he was on a call with other Goldman Sachs people talking with the principals after the blow-up occurred. And he said he was startled and deeply impressed by the depth of sophistication on the part of these authors, the failure of long-term capital management. And they knew much more and asked much better questions about valuation and the composition of the assets and the hedge technique than did the Goldman Sachs traders who were trying to value this stuff. And Emmanuel takes away from this that sheer mental power, sheer mental acuity is not invariably the road to riches. It's not necessarily the equipment that gets you where you want to go. I don't think he used the word humbling, but it gave him pause for thought, and a lot of times on Wall Street, the simple common sense, I don't get it. Tell me again. So you're telling me that you put all these sub-investment grade mortgage tranches together, slap them together, and the ones at the 40th percentile of the stack have been transmogrified into AAA securities. Is that where can you go over this again, this time more slowly? But anyway, so the population of intelligent people on Wall Street is quite a large proportion of the practitioners. And so at the Fed, there are 1,000 or so, more than 1,000 or whatever, the PhDs in economics who failed to foresee 2020 and 21 that if you infuse the wallets of the population with thousands of dollars of stimulus and open the spigots of the central bank and promise through the central bank that interest rates will be low, what you will generate is a great investment bubble and a spending spree by people who have been given all of this money, and which will result in inflation. And the Fed, with all of its hundreds of PhDs, didn't happen to come to that kind of commonsensical conclusion. So all this is by way of a very windy way of affirming that brains aren't everything.
No, absolutely. And you've written a lot about artificial intelligence in grants. Obviously, this is one of the things that's been driving the euphoria in the market. And you've talked about the insatiable enthusiasm for anything related to AI. I was looking at one of the daily newsletters that you send out from grants the other day.
Daily grants.
Almost daily grants.
Yeah.
It was talking about how Amazon, Microsoft, Alphabet, Google, Meta, Oracle, and CoreWeave will splash out $382 billion in capital expenditures this year by Citigroup's count, up more than 50% from 2024 and triple that seen in 2023. And you said that the Magnificent Seven now accounts for 31% of the S&P 500's total capital spending, from 19% at the end of 2019. And you point out that there are these firms like OpenAI and Anthropic that have raised billions of dollars every few months and are now valued at hundreds of billions. And so you wrote this piece in July about the check writing contest within the world of AI, where everyone is basically racing to invest as much as quickly as possible. And I just was wondering, as a battle-hardened investor, an observer of craziness as you are, when you look at this excitement, how reminiscent is it of previous booms, whether it's the railroad bubble that ended in disaster in 1873 or the dotcom bubble that ended in disaster in 2001, or is this really different this time? Can you put in some context what we're seeing here?
I think what we are seeing is the promise of a marvelous technology with human characteristics. And those human characteristics have to do with falling in line and doing what others do, and if possible, doing more of it, higher, faster, and louder. So it reminds me a lot of the fiber optics check writing contest of the late 1990s. How much of the stuff you put in the ground? Is there demand for it? Well, there will be. Or the, as you say, late 1800s, the railroad building contests, as it were, the check writing contest to lay down more track, parallel track to your competitor, but still the contest is worth it. We'll beat that. So there's a lot of redundant capital investment then. And then these things end invariably with a panic and a crash. I think that's the model for now. Another point that David Rosenthal made was the problem with the capital investment may not be so much in its size, but rather in the demonstrated fact so far that people are not willing to pay for the product of that investment. With extraordinary sums being laid out for data centers, these buildings that in the case of, I think Meta is building something the size of Manhattan Island, well and good, except are you going to get paid for it? College students go away in the late spring and don't come back until the fall, and when they go away, the demand for AI goes way down because who else has such a deep and persistent need for plagiarism? They have to plagiarize papers to get through the year. So the demand for AI falls off markedly and measurably come the springtime. I hear myself saying, I sang I Get a Horse in 1903. It's cars, they stink. Look at the tires are blow up all the time. Where steamboats explode and kill hundreds every fiscal quarter in 1840s. I'm not even talking so much about the technology as the very human response to great technologies and the promise thereof. And don't forget, this is still a promise. The question, what comes next? Is it the realization of the promise with the payday? Or is it the crash that precedes the realization and the payday? I perfectly well can see this stuff is going to do wonders for somebody. But for the time being, people seem not to be willing to pay for what the producers of these large language models are laying out to achieve them and to compete with others achieving them. So I'm all in on the comparisons to the busts of yesteryear. I think that's the model for now.
There was a lovely quote that I don't know if I had heard before, that your friend Pierre Lassonde, who's a very successful gold bug, quoted from Voltaire, where he said, "History never repeats itself, man always does." I thought that was quite revealing about what happens with these deals, right? Like the tendency at certain times in cycles for people to get carried away. And you had someone, I think, at your other conference, the credit conference earlier in the year, who was saying exactly the same sort of thing, that basically at times like this, there's just this sort of fear of missing out. I think it was Michael Gatto, who's head of direct lending at Silver Point Capital. He said, when there's a lot of capital and the emotion is greed and there's fear of missing out, bad deals get done. And similarly, when there is a lack of capital and the emotion is fear, great deals get done. And so I think this is one of those areas where it's not like we can say what's going to happen with AI and all of this spending, but there's a sort of familiarity to the pattern of human behavior here. Is that fair to say?
I think, yes, I think it is. When Pierre said, history doesn't repeat ours, he's not going to say, but it rhymes. Don't say that.
Yeah.
Not again. So, but Pierre had Voltaire's twist on this. I guess, no, maybe Mark Twain had the twist on. Maybe Mark Twain never said it. I don't know.
I suspect Voltaire didn't say it either. Whenever you are writing a book, you look back and you check the origin of these quotes and you discover very inconveniently that nobody said what we claim they said.
He should have said it, yes.
If Voltaire had been smarter, this is what he would have said.
And more cynical.
Exactly.
Possible.
Exactly. So assuming that AI has been driving a lot of the euphoria in the current US stock market, there is ample reason to be a little wary of what we're seeing in the US market. And you've reported recently in your newsletter that the S&P 500 is priced at more than 40 times its cyclically adjusted price to earnings ratio, and that back in the fall of 2021, it was at 38.6 times. And you said that that means it's the richest reading in history after the dotcom bubble, when it was 44.2 back in 1999. Can you put in context, when you look at the market at the moment, when you look at US stocks, like this isn't a prediction of what we think is going to happen, but can you give us a sense of why it's wiser to proceed with caution than with our foot as heavily on the gas pedal as possible?
Yeah, well, everyone has to be in. And valuations show that. But apropos of, there are many ways to make money. We heard from John Hughes, who is a renowned compounder of capital. It's a very concentrated portfolio and companies that embody the virtues he thinks are that dispositively define a great investment. And they have to do with barriers to entry and with capital allocation and with management quality and the like. And he holds it through thick and thin, and he's done marvelously through all manner of thins, right? That's Warren Buffett's counsel is too. With respect to people who are listening, perhaps a lot of this has to do with their age and with their risk tolerance. And if you are starting out and you have a reasonably diversified portfolio and you're in your 20s, and I think it's entirely prudent not to pay attention to what I am now saying or to talking about. These macro things come and go. If the long-term America's great is going to be great, I am this. But say you, hypothetically, you're a gentleman of a certain age and you own a lot of stocks, and you might want to pay a little bit more attention to the signs of excess, and they are at every hand. Valuation, sentiment, the incidence of unmistakable corrupt promotion, the swaggering of newly empowered through wealth people who know only one thing, which is that markets only go up. It's all here. The whole theater of the major financial markets top is on the stage. The theater is opened, and the pageant of top making scenery and actors and script, all that is in play. Now, the question of timing. Does it have to end now? No. Does it have to end in 2 years? No, it does not. But end it will. A lot of legends of people who got out in time in 1929. I wrote a book about one of them, Bernard M. DeLuc, who's a great speculator. He's the subject of my first book, way back when, like 41. The legends come down through the years that Bernard DeLuc sold on the eve of the crash in 1929. No, he did not. And I had the stock market, I had his records to prove it. But what he did do was take the measure of things in 1930 and get out salvaging like 60% or 70% of his capital in a cycle that would denude the buy and hold investor by up to 95% or so of his capital. And that took 20 years to wear off. That cycle's Dow made its high in 1929, and we captured its high in 1954. To put that in context, that was the year the Giants were in the World Series. It was the most extraordinary. Now, if dividends are counted, market came back before then. But if you just look at the Dow, I guess that's 25 years, right? And my mentor and boss at Barron's, Robert M. Bleiberg, he was a Depression child and quite vivid memories of the crash and its aftermath, and was very, very cautious in 1954. What he did not say in 1954 is, oh, he was a great markets man, very good instincts. And I went back and read his stuff in 1954, 58. What he did not say was, we are on one of the greatest eras of American prosperity and investment success that you won't be able to believe. It's all in front of us. There will be bumps in the road, but consider that, put away those memories of the bad old days. They are not germane. But yes, I think that this is a major top in formation. I'm with Nate Kopikar, with others, and with myself. I don't need anybody else to help me along with this. But Nate did such a good job in exposing the underside of things, the point of view of credit in private markets. It will come unstuck. And you'll have me on the show, William. And I am not going to gloat at all. You know why? Because I have been around the block. The important thing is to recall at moments like those we're expecting some of us is that just recall how full of beans you were in the run up to the moment of crowning success. Just remember that.
It's a very difficult game, right? I was listening to an interview that David Tepper, who I've never interviewed before, but who's obviously a very smart, very successful guy, he had done on CNBC when he said, we're having a really good year and I'm so miserable because I still own the market and I can't stand that I own the market. But he said, I'm not ever fighting this Fed with all these expectations of interest rate cuts coming before the end of the year. And he said, you've got to stay for some of the party because the punch bowl is still there. They haven't taken it away yet.
He is a constantly successful speculator. I remember watching him on CNBC in 2010. Remember when Ben Esperanza, PhD, wrote the piece in the Washington Post saying, we are going to institute QE, and this will infuse the net worth of the people who have equities, and America will be growing again because the stock market will be rising again. That was essentially the argument. I remember David Tepper. I remember he was sitting on a set in CNBC, and it was a chair. He was going like this, nervous and going back and forth like this. And he was exactly explaining how this was going to happen. And it happened exactly as he said it would. He's someone to pay attention to. If he were listening to, he'd probably say, don't follow me. I'm miserable because I know full well all the odds are against much more of this, except he's also in the business of not getting off the train prematurely. Not FOMO, because he's rather too sophisticated for that. Although I dare say, as a human being, he's not immune entirely from it. But he knows also that things go on so much longer than you would think they would, or as a moralist should.
Yeah.
If you happen to be a moralist, should. He's getting on the Fed. I've often bet against the Fed. I can't stand this adage, don't fight the Fed. I've made my life throwing hard jabs and left hooks at the Fed, and occasional overhand right at the Fed. And they never hit back, except sometimes I feel the blows.
Yeah. People will be shocked if I don't ask you very briefly about the Fed. We talked at great length about it last time on the podcast, your lack of tremendous enthusiasm for the way the Fed is run. But if you could just give us a sense of how you expect the Fed to handle what's really a very challenging economic situation at a really important juncture with, I think Chairman Jay Powell's term expires in May 2026. And you interviewed Kevin Warsh yesterday, who served on the board of governors of the Fed until 2011, and who a lot of people are saying could be Jay Powell's replacement. Obviously, there are a lot of demands for the Fed to lower interest rates and the like. And when you look at this institution and its position at this very interesting juncture, what do you see? What should we be thinking about?
I think we'll be looking at the administration's attempt to conquer it, to subjugate it, and to institute its own regime of ultra-low interest rates at the Fed, having conquered it. I think for the Stephen I. Moran is the advanced, kind of the Praetorian Guard of MAGA on the Fed. He came under a questioning by Elizabeth Warren on the Senate Banking Committee, proving his fitness for the unique position of chairman of the Council of Economic Advisors and governor in the Federal Board. And she said to him, tell me, Mr. Wood, did Donald Trump lose the 2020 election? The answer. The Senate confirmed Joe Biden as the winner of the election. We know that, Mr. Wood. Did Donald Trump lose the election? The Senate confirmed. So it's the robotic response to me is a little bit concerning. The people around Trump are somebody saying, Mr. President, you had your golf cart-sized bottom kicked in 2020. May we please move on? I dare say no one at all is saying that to him now. And also, Mr. Moran, the Bureau of Labor Statistics, did they fake these numbers to make the president look bad? The quality of the federal economic data has been declining for some. Yes. Did they intentionally, the quality of it like that? It would not be a shock to me that the president's views on interest rates, which everyone knows, lower the better. In 2000, whatever it was, 2010, his late teens, his line was, the Swiss have negative, and the Japanese have negative nominal. Why can't we have negative? Why are we paying any interest? What's wrong with less than zero? He still thinks that. If he does subjugate the Fed, if he manages to bring his own people in before May, I think we can look for much lower money market interest rates and a much weaker dollar and a much steeper yield curve, meaning that longer dated interest rates, longer term yields, bonds, mortgages will be higher, much higher than short dated money market instruments like T-bills. So what MAGA believes, well, they might be right. Who knows? I gave up certitude a long time ago, although it may not sound like that something. But there's great hope for AI, great hope for transformation of American productivity. Not after the crash that has typically occurred with excess exuberance and investment, but before, so like next year after, productivity revolution. No, there's going to be a crash first thing. You'll be sorry you ever heard the phrase AI. That's how bad it's going to be. Yeah. That there's hopes for a productivity revolution such that this country could handle much lower interest rates, a much more dynamic, as they use the word, credit market, where people can access the credit market and find affordable mortgages. The housing market's going to take up after this long. Some people can't afford to move. That'll change. They paint a wonderful picture of what life might be like after the president finds his people and plants them at the Fed. As Donald Trump himself often says, we'll see. Or we'll know more in 4 years.
So while we're busy worrying everyone that we haven't already alienated, let's talk about government debt, which also was a major recurring theme at the conference yesterday. Pierre Lassonde, the gold investor we mentioned before, pointed out that the world is drowning in debt, as he put it. And he talked about the fact that there's this overstretched fiscal situation, not only in the US, but China, the UK, France, and elsewhere. And he had some amazing statistics. He said that the total global debt has risen from $16 trillion in 1980 to $314 trillion in 2024. And likewise, he said that US federal debt has risen from $1 trillion in 1980 to $37 trillion in 2024. You've also pointed out in grants, you said nothing puts the fiat money era in starker relief than the fact that it took the US 222 years to borrow what the efforts of Presidents Biden and Trump achieved in not quite 8 years. So we can be equal opportunity in blaming different parties for the history of recklessness here. But can you talk about, give us a very practical economics lesson for people like me who don't understand this stuff. Like, you've argued for a while that the fiscal deficit's unsustainable. Can you give us a sense of what's causing the problem, what's likely to happen, and most important, perhaps, what the implications are for long-term investors like our listeners and viewers here?
Let's take the contrary argument first, which I have to deal with. There was a time when the contrary argument was upper in the minds, uppermost in the minds of people. And that argument held basically that, yes, debt is a thing, but so is the income that the debt produces. And for every debtor who may be worried about overindulgence, there is a creditor who is more than happy to buy those items. And in the case of a country such as the United States, whose currency is sought after and accepted worldwide, there's no limit to what you can borrow. And that particular line of reasoning has held up until this function up to this very moment. I mean, so as we speak, the government, I guess, is still shut down. It was supposed to be shut down. The world still seems kind of okay with our shenanigans and our debt, and it's because they like the dollar still. It's the world's reserve currency, meaning the currency that enjoys the kind of the Coca-Cola quality brand name, and people accept it as good money, even though they're not sure what's behind it. Is it just the promise of government, or is it something? Okay, so that's the argument against concern, against anxiety and worry, right? So the argument for concern is that the burden of interest and the weight of issuance will exhaust even the friends of this country and the friends of its dollar.
Later this year, I'm going to be launching a Richer, Wiser, Happier masterclass for a very small, select group of people who'd like to study with me over the course of a year. We're going to meet once a month over Zoom, typically for about 2 hours per session, to discuss the themes in my book, Richer, Wiser, Happier. We'll also meet in person at a couple of really special events. I'm going to cap the group at a maximum of 20 people, so this is an unusual opportunity to study very directly with me in a small group. What sort of people am I looking for to join the masterclass? Well, really anyone who's deeply interested in exploring how to live a life that's truly richer, wiser, and happier. This is the second time that I've taught a Richer, Wiser, Happier masterclass, and I'm planning to do this again because it's really been a totally joyful experience for me over the last year. The group has included an amazing array of 20 people from 6 different countries, and I can tell you that the current members are an incredibly interesting, accomplished, and really delightful array of people. They include some extremely successful fund managers, some investment analysts, wealth advisors, heads of family offices, CEOs, entrepreneurs, a management consultant, really renowned physicist turned quant investor, and a friend of mine who's a highly successful professional gambler. The common denominator here, I think, is that they're all united in this desire to live a truly abundant life, and they're also all great learners. One of the most joyful things for me personally has been to see the friendships form between these remarkable people as they learn from each other and support each other. In any case, if this sounds like something that might appeal to you, please email my friend and fellow podcast host, Kyle Grieve, at Kyle, which is Kyle, at theinvestorspodcast.com.
Are you looking to connect with high-quality people in the value investing world? Beyond hosting this podcast, I also help run our TIP Mastermind community, a private group designed for serious investors. Inside, you'll meet vetted members who are entrepreneurs, private investors, and asset managers, people who understand your journey and can help you grow. Each week, we host live calls where members share insights, strategies, and experiences. Our members are often surprised to learn that our community is not just about finding the next stock pick, but also sharing lessons on how to live a good life. We certainly do not have all the answers, but many members have likely faced similar challenges to yours. And our community does not just live online. Each year, we gather in Omaha and New York City, giving you the chance to build deeper, more meaningful relationships in person. One member told me that being a part of this group has helped him not just as an investor, but as a person looking for a thoughtful approach to balancing wealth and happiness. We're capping the group at 150 members, and we're looking to fill just 5 spots this month. So if this sounds interesting to you, you can learn more and sign up for the waitlist at theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind, or feel free to email me directly at clay@theinvestorspodcast.com. If you enjoy excellent breakdowns on individual stocks, then you need to check out the Intrinsic Value podcast hosted by Sean O'Malley and Daniel Malka. Each week, Sean and Daniel do in-depth analysis on a company's business model and competitive advantages, and in real time, they build out the intrinsic value portfolio for you to follow along as they search for value in the market. So far, they've done analysis on great businesses like John Deere, Ulta Beauty, AutoZone, and Airbnb, and I recommend starting with the episode on Nintendo, the global powerhouse in gaming. It's rare to find a show that consistently publishes high-quality, comprehensive deep dives that cover all of the aspects of a business from an investment perspective. Go follow the Intrinsic Value podcast on your favorite podcasting app and discover the next stock to add to your portfolio or watch list.
And those are friends, both domestic and foreign. And I've seen signs of this already. You've seen in 2019 and 20, saw a little anti-bubble eruptions concerning the market's willingness to accept what you saw in 2019 and 20 was discontinuity in the supposed deepest of all world security markets. 2019, it concerned the money market, short end of the money market, short-dated interest rates, because suddenly there was a crisis in the funding market for our debt, meaning access to short-dated loans with which to buy bonds. That was in the fall of 2019. And in 2020, there was a fright scare in around March and April concerning the world's tolerance for buying more of our longer-dated securities, like the 10-year and 20 and the 30-year bond. And that happened to do with the pandemic and with the Treasury's evident plans to borrow a lot of money, and the Fed's expressed intention to buy a lot of bonds with money that didn't exist until it was ready to print it. So those were amber lights. So the question really is, what is the ultimate demand for U.S. securities at these rates of interest? So another question, are they marketable at any rate? So if the United States was going to sell Treasuries, a 10-year note, not at 4-something, not at 4.18, 4.18%, but rather at 10%. Wow. That would be a little bit of all right? Or 12%. Also, that's the debt. This is not isolated to the sovereign debt. Consider also the private debts that have been accumulated. And to be sure, private bonds that receive the interest on those debts, right? There's a two-sided argument, pro and con. But the U.S. economy, as resilient as it famously is, has been rendered much less so, rather vulnerable, by the years of near 0% interest rates that precipitated and encouraged the deal-making in private equity and elsewhere. These aforementioned more than 20,000 companies that are now trying to find their footing at a time of interest rates they can't quite handle. And so what happens if the world loses its taste for American securities owing to the shambolic nature of the administration, if I may so characterize it? And if inflation, for example, comes back in an unscripted fashion, the Fed can't lower rates in good faith, but rather must consider raising them, how would higher interest rates play in this world of financial fragility, at least as some of us see it? That's a kind of an attempt at an overview of what's wrong with too much debt. Part of it is the American brand in dollars and debt being corroded and debased by overdoing it, by overissuance. And then there's the question of whether, in the event of, say, an expected inflation, whether the private sector is going to be badly damaged by the need of the Fed to post higher interest rates. So the reason that people like clean balance sheets is that it affords the borrower, or the would-be borrower, the future borrower, with flexibility. That's why companies with clean balance sheets get primatur of AAA or AA. Very few AAAs. But that's clean balance sheet. That's good. It's good because that company can opportunistically invest when the times are difficult. But when the times are difficult in this country, the government famously, because of its construct of the welfare state, must borrow much, much more. We are borrowing heavily in a time of a 4% plus rate of unemployment, long thought to be full employment. And we are borrowing at a time of roaring markets and of a GDP that is rising, according to the Atlanta Fed, at a rate close to 4% annualized. Wow. We need a 6 or 7% deficit to make things work. That doesn't sound like a well-managed public finance operation. So these are latent problems now, as I say. Look at the screen. The bond market's kind of okay. Credit spreads, meaning the premium of private borrowing costs over public ones is near an modern all-time low, meaning no anxiety about private debts. So the arguments against heavy borrowing must be made rather defensively for the time being. This thing, I'm pretty confident. I think that the too much debt argument will prevail, that we will rule much of our mismanagement of the public credit and of so much private credit.
I wanted to talk a bit more about inflation. I was reading a back issue of Grant's from earlier in 2024, where you connected inflation basically to flaws in human nature and used this as an argument for why we can expect a future of more inflation in what you've described as inflation nation America, that is. And you quoted a German economist called Wilhelm Röpke, if I'm Röpke, if I'm pronouncing it right.
Yeah, it's exactly right, yeah.
I wanted to read a little bit of what he wrote in the 1950s because you wrote, has anyone said it better? And so I'm going to read a few sentences to him that maybe
That's our anthem here. Yes, please.
So he wrote this in the 50s about inflation as the way a national economy reacts to, quote, a tendency towards excess in every sphere and all circles, to a presumptuous overconfidence in oneself, to a frivolous attempt always to draw bigger checks on the national economy than it can honor. And then he said, people want to invest more than savings permit. They demand wages higher than the growth of productivity justifies. They want more imports than exports can earn. And above all, the government, which should know better, raises its claims on this overstretched economy higher and higher. Thus, there is a riot of claims and an insufficiency of goods produced to meet them. And then he talks about the impact that this tendency in human nature has on money. And he writes this very elegantly. He says, just as there are organs in the human body in which, if consistently abused, ailments slowly but surely accumulate, eventually taking their revenge, so the national economy has its own equally sensitive organ. That organ is money. It becomes feeble and ceases to resist, and it is this enfeeblement which we call inflation, a dilation of money, so to speak, a managerial disease of the national economy. Can you unpack that a little bit? Because it seems...
No, I cannot unpack, because it's like, can you unpack the Declaration of Independence or Lincoln's second inaugural address? All I can say is, man, I mean, it's an overstraining of things. It's an overstraining. What you can read and impute in his writing is that some of what he was saying is the way things worked under the gold standard. When there was this overstraining, money would leave the country. Gold, being money, would leave the country. And because paper money was unacceptable in the world, acceptable within the boundaries of the nation that could print it, the departure of gold was a deflating force. You were losing the monetary base. You were losing the capacity to issue credit, debt, loans, credit, debt, and that was how the body politic began to protest. Now, in this age, you have a reserve currency country, America, meaning it's the kingpin, monetary kingpin. And there is, to date, no real hard limit on how much it can do. There are some softer limits than the ones to which Ripka, I think, was referring. One is domestic protests against the too high rate of inflation. But the Fed is capable of finding that away. It's got this prestidigitation, this magician stuff. So now they're saying that 2.8% is a little bit of all ways. It's fine. But be vigilant. We won't let it get away from us. So you watch, it's 3%, it's going to be a little bit less fine, but we've got this. And certainly Donald Trump is going to say, I'm not sure he's going to use the word transient, but I think he might say it's going to go away. AI will wipe it from the slate. But what a beautiful succession of sentences you wrote describing what I think is almost exactly, this dynamics of inflation. And notice as well, inflation under a paper money system, that the dollar never regains the purchasing power it loses to inflation. Now, William McChesney Martin, longest-serving Fed chairman, said that the dollar never regains the purchasing power it loses to inflation. In times past, it would be prices would go up and then go down. But in the business cycle, no more. One of the things that I think helped Donald Trump get elected in 2024 was that people saw inflation even when the rate of inflation declined. Well, they should, because the prices they saw, not the prices they knew in 2019 and 20. So the economists are saying we're confusing the rate of inflation with what people saw with their very eyes in the supermarket. I don't care what they're saying. Look at this. Look at the price of eggs, let's say, for a time.
Eggs are no problem for me, but I drink a lot of coffee, and I had a cappuccino, a large skim cappuccino, to neutralize the effect of the blueberry scone that I had with it the other day here in Westchester, New York. $21. That's just stunning, isn't it?
One of the interesting features about the present day and the Fed's concern or lack thereof is the price of gold, which is kind of knocking on the door of $4,000 an ounce. It was $20.67 from basically Alexander Hamilton. There's some ups and downs until 1933. And then it was $35 notes approximately, again with some wiggles, until 1971. Then it was cut loose, cut off the gold standard, what remained of the gold standard. And it was free to float. It did float. But now it's kind of gone bonkers. And people who are just as worried as our friend David about his stocks, what's driving it? Is it priced as it is only to disappoint its many somewhat bruised and calloused followers by collapsing as it did in 2011? 2011, the price got to $1,900 and something an ounce. And what followed the next 3 or 4 or 5 years was a return to like $1,200 an ounce. And the collapse in gold mining shares, upwards of 90% in some of them, 95%. Well, everything's kind of out of whack, right? The credit spreads are out of whack. Gold seems, even for the gold, people who love it seems, and love it is unfortunately the word for many of us today. It's a seductive asset. It's not just any old asset. It's not broom handles, so you fall in love with it or not. It was like Bitcoin, some people fall in love with it or not.
And you've had a long love affair with this. I mean, you bought it in January 1980, I think, your first Krugerrand for, what, 850?
I don't mean to brag, William, but I happen to have invented it.
Oh, well, nice job. So you're a few thousand years old. Good job.
Don't let looks to see if it was, I think, 2,300 years old. So I wear that, should we say, not pinpoint timed purchase as a badge of honor, or at least of constructive humiliation to, I don't need to remind myself, but others who might mistakenly, in their ignorance, fasten the guru title on me with the gold price. Perilous on the conference showed this very well. Gold moves in cycles, and it can go sideways or down for 15 years, and then he puts it down to an overissuance of the public debt and the questions about the public credit. And then it just takes off like a stuck pig. It startles everyone, as it is to us now, I think, even its fans. It's a curious kind of bull market because public participation is still rather muted. There are signs of it growing. But there isn't the frenzy you saw in Bitcoin in 2023 and 24, for example, or common stocks today.
You've been pushing gold for many years, right, in this sort of very contrarian way. And now that it's hit...
Seems awfully crass.
Sorry.
I'm in the commission business.
touting, hawking,
Advocating.
peddling. And now that it's hit 3,900 an ounce this week, and it's up, what, a good 40%
Yeah.
this year. It must be very uncomfortable for you as someone who is always a skeptic. Now you're looking at it and thinking we have a speculative bubble in gold, or is the run-up justified given the backdrop of all the kinds?
I happen to be in the presence of one of the great speculators of our age in the springtime. And I said, this is what it was. I guess closing in on 3,000. I've lost track of one, but it just cleared some high hurdle. And I said, you think gold's a bubble? He said, of course it's a bubble. I said, oh, is it justified by what we on Wall Street are pleased to call the fundamentals? And this is where you build this narrative for yourself about what's causing it. I remember very well in 2011 that the S&P had downgraded the Treasury from AAA to AA plus. And by the way, lived to rue that for the next 10 or 15 years because the authorities went after them big time for having had the temerity to do that. And the price of gold had been in the mid 1,500s for a while. I thought some of us thought that, well, now the world is catching on to the joke, and the world will demand of this country a reform in the finances, which will entail some role for gold in the monetary system. And gold will find its place at a higher price. I'm not sure we actually use the phrase permanent high plateau, but that's what a gold standard is. It's literally a permanent plateau. It's not necessarily high or low, but $20.67 for 135 years is a high plateau, or it's a plateau. $35 for decades was a plateau. So that was some of the thinking among the thought leaders of the gold world. It turns out that there was not any such thing as a worldwide permanent condemnation of our messy fisc, nor was there any intention on the part of the authorities of bringing gold back into the world of America's monetary system. America has read out gold from its monetary affairs starting in 1976 under Treasury Secretary Bill Simons. Absolutely said, we're going to turn our back on it. No more gold, period, in the IMF or in the Treasury. Gold it might as well be scrap metal that is housed under guard, to be sure, in Fort Knox and elsewhere. But no more gold. So you can build these air castles of narrative. My current castle, if I were to have built one, would consist of an administration that seems bound and determined, unlikely will prove to be successful in taking over the central bank and imposing its interesting theories of money market interest rates on the dollar and on the world. It uses the dollar. It's one plank of this air castle. And another would be proclivity of the Treasury to borrow much more than it takes in, and the Congress to allow that. And for the fiscal dilemma you talked about but never acted upon, it's another one. So that would be enough to convince me that the upside is still in front of us. But you can't be sure. And if you have too much of this stuff, you have a restless night's sleep. But you don't want to, as David Tepper, you don't want to miss all of the upside. So that's what makes this line of work so interesting. There's no firm answer. There's no certitude. There can't be. And people think they have it. One thing about, there are two things about it. They're not very old. And they have not really had the invaluable educational experience of having their face ripped off during a bear market. There's two things you know about them, or one of the two.
I always remember Bill Miller many, many years ago saying to me, there is no certainty. It's all probabilities. And it's very unsettling. And so, in terms of just being a prudent investor, to position ourselves, and this is before we turn to your book, which I want to talk about next, to position ourselves sort of prudently given the backdrop. You don't much like bonds. You said basically in 2021, we entered a 40-year, after a 40-year bull market, we've entered a long period of bear market.
I own some bonds personally. My wife and I do, because no one's getting any younger. And I dearly love gold, but you'll notice that it is deficient in one thing only. It pays no interest, which is also one of its great virtues. It's money. It's simple. It's money. The world regards that with bonds. So I own some. It's a fund that invests in special situations that yield rather more than the ones that trade. in public markets. And it's risky, but risk is well managed. So that's part of our lives. And this is about for the time. I intend to work my whole life. I don't have any intention of retiring, but prudence would dictate that there's some reasonably assured income outside of Social Security. So that's that. So that's my codicil to and my anti-bond stance. I own some of them.
I saw yesterday at the conference and talked to briefly the great Paul Isaac, who we talked about last time you were on the podcast,
Yes.
who you'd invested with many years. So I'm assuming you still have some exposure to the stock market through people like Paul.
Oh, yes, I do. I do. And he's coming into his own. All these stocks that stood still are seeped lower and lower. Of course, in the past 5 or 10 years, coming into the bonus, it seems to be by way of preface, it's a doesn't necessarily deep value investor. They look for special situations that he feels are potentially downside. And this would have to do with the quality of the balance sheet, of the earnings stream, of course, of the price that affords some protection. It's been beaten down and ignored sufficiently by Wall Street. There's some protection, and it's very obscure. It's not going to be a part of the kind of portfolios that will be liquidated. It will pay a price during the liquidation because it's traded somewhere. And this has to do with companies, so banks, for example, in Europe. And it has to do with medical device companies in this country that are kind of on the come, that have been neglected because they once failed at something. I'm not sure special situations is a better description of some of his investing style than value, but he looks for opportunities that will not necessarily be borne aloft by a great rush into Mag 7. And they have been left behind, so he has suffered by comparison with that. But these things say, wow, sorry, what?
Yeah, it's brilliant, man.
Unless what is happening now is every last dog is finding its adopter from the pound. It's like the pandemic dogs, even the most improbable beasts get let out of the pound.
Let's hope that he's not listening to this and thinking you're describing him as a three-legged pandemic hound who's finally having his day. But I think the point is that it's not like you're going to cash and crawling up in fetal position in the corner. It's about taking intelligent risk, whether it's with gold and commodities or bonds or diversifying beyond the US market and beyond the... So this isn't you advising everyone to panic and cash out. It's just saying be more conscious of the risks that you're mindlessly taking.
Or take them thoughtfully, even though it's well and good to anticipate your peace of mind come the liquidation. But everyone's got a plan until it gets hit, the Mike Tyson line. I never underestimate how sweaty your palms are going to be. These liquidations can seem unending. They typically don't.
It's also about I was listening to Grant's Current Yield podcast, and you were talking about how we're in the age of decadent finance. And so part of it is about being wary of having stuff sold to you that's kind of marginal and speculative at a time when we should be being more prudent. And there was a lovely line you said, we at Grants take a rather moralistic view sometimes. Instead of credit being man's confidence in man, in this day and age of decadent finance, it now demands man's confidence in the sagacity of his lawyer, because the ingenuity of the strong and the cunning, I'm misstating that, but you get my point that what you were saying is you can't just be trusting at a point like this where all of the most rapacious, cunning people come out to try to sell you stuff that is not necessary.
And all the most rapacious and cunning people have done very well by their rapacity and by their guile. It's markets, when allowed to function properly, go down as well as up. And the down portion serves any number of functions, one of which is to skim the bad actors off the stage, just to flick them away. But what happens when the Fed, with every good intention, I'm sure, lends its force, its arm, and its strength to prolonging cycles and forestalling bear markets and to pumping up the GDP so that we never have to endure this experience again? So bad conduct goes uncorrected, unchastised. Mr. Market is the best disciplinarian. Never mind all these homely lessons that you can read that reflect on Warren Buffett. He is a great coiner of phrases, but Charlie Munger. But nothing succeeds like having your head handed to you as a learning tool. Disbarment in the case of the bar, or de-licensing in the case of financial advisors, just to get some of these people out where they ought to be, which is like, I don't know, working for the Fed. I don't know whether they can go after this, get them out of the markets where they have lingered too long and they're going to get too many people in trouble. So that's my moralistic argument.
Let's turn to your lovely book, Friends Until the End, which is a double biography of these two magnificent 18th century orators, Edmund Burke and Charles James Fox. And it's set against the backdrop of three great events, I guess. So Britain's loss of the American colonies, the rapacious exploitation of India by the East India Company, the great dominant monopoly of its time, and also the French Revolution. And it would be great if we could chat for half an hour about the book and the lessons therein. Early in the book, at the end of the preface, in writing about Burke and Fox, you say, I love them for what they said and the way they said it, for what they believed and for what they did. Can you give us a sense of why you so greatly admire these two figures who are in many ways giants, but also have been widely forgotten by many people, although Burke obviously is an important figure in the world of conservatism still?
For me, at least, great oratory is like music. I read it as I would listen to the third movement of Brahms's Third Symphony, which I happen to love. May I read you a little something?
I would love that, yeah.
This is Burke's panegyric to his friend Fox. And the preface to this is to bring the British East India Company to heel, to curtail the most abusive practices of its agents in India. Edmund Burke and Charles Fox together drafted a bill to revise the governance of this monopoly that is the biggest company in the world, the Shire. Fox, who was the front man for this in the House of Commons of Great Britain, bore a lot of abuse because if the bill went through, he would command a great deal of power in nominating functionaries to serve on the new governance commissions. So he had all this power awaiting him if only the bill would get through. So this is Burke saying. So they question his motives, but he has put to hazard his ease, his security, his interest, his power, even his darling popularity, the benefit of the people no one has never seen. This is the mode that all heroes have trod before him. He has traduced and abused for his supposed motives. You will remember that obviously is a necessary ingredient in the composition of all true glory. You will remember that it was not only in the Roman customs, but it's in the nature and constitution of things that calumny and abuse are essential parts of triumph. Now, is that not a wonderful read? That speaks to the first point I tried to make there, was that what they said, how they said it. The book is so well seasoned with quotations from both Burke and Fox. They're both magnificent speakers, and they both came into their prime after stenographers were at least semi-legally allowed to the House of Commons to take close notes. They couldn't get all of it. It's like catching a bird on the wing, and they were writing, scribbling in shorthand about creation. But witnesses to Fox's and Burke's eloquence contend it was much better than what you read in the page. Oh my goodness, it's pretty good on the page. So that was what they said and how they said it.
There was an amazing line from Boswell in your book, the biographer of the great Dr. Johnson, where he said, watching Burke, if I get this right, it was something like being in this orchard where he could just pluck these apples at will, like so fast. And I think one of the amazing things about their oratory was both of them, they were so brilliant and so quick speaking and quick thinking that they could be quoting Virgil and Horace, and they would be quoting in Latin from memory. And the same with people like William Pitt, who became Prime Minister at 24, who you quote. I mean, I think there's a bit in the book where Pitt suddenly quotes Scipio in Latin from memory about some old guy who's insulted him. I think that's part of what's so amazing about the rhetoric, the oratory that they use.
Yes, at one point, I'm not sure how much this is documented, but supposedly Lord North, who was the Prime Minister during much of the time, was in the House of Commons, as was Burke. And Burke was lacing into the government on Lord North, and North happened to be sleeping during this. And Burke then quoted something about it. But North heard him misquote something about it. And he awakened, corrected him, and then feigned return to sleep.
I had an amazing history teacher, a legendary history teacher at Eton, which is where Charles Fox went, and Pitt, this guy called Michael Kidson, who now, if he was still alive, would be banned from teaching because he would say such incredibly inappropriate things. But he was wonderfully articulate, and he would always say, they were giants in those days. And you get that sense not only from the quality of the rhetoric, of the actual use of language and hyperbole and just all from memory, and a lot of it off the cuff. Anyway, they wouldn't deign to look at their notes, and Burke could speak for 11 hours.
It was very bad. It was very bad form to speak from a script.
Yeah. So amazing. But then also, and I think this is probably what you were about to get to, it's not just that, it's the moral courage that they demonstrated. And I mean, if you could talk a bit about that, because that certainly comes through, particularly with Burke, like this sense of his humanity and his moral courage and his compassion. And there's a point where he says that he has one rule for himself, which is to act as the representative of the people who had no power. Can you talk about that? Because I think that's the other thing where you feel not only that you're uplifted by reading the quality of their language, but also the quality of Burke's morality and decency.
He was a difficult person, personally, so many occasions, but he was also, most of the times, incredibly generous and courageous in the causes he would take up. For example, 2 guys were caught making love. And of course, it was crime, serious crime. They were hauled before the bailiff and sentenced to a time in the stocks. And put your head and your arms through this and would stand before all the worst people around, and they would toss stuff at your head. Sometimes merely vegetables, and other times rocks. And these 2 male lovers suffered rocks. One of them was killed in the stocks. One of them was maimed. I'm not sure he died, didn't die either. But Burke took up their cause in the House of Commons. Now, of course, you can imagine the ridicule came down his head for this, and all that, and knowing leers one member to another on the other side of the House of Commons. The government leers at this man who must have had both curious motives for taking up the cause of these 2 reprobates, these 2 offenders against the laws of God and nature. But Burke persisted, and a newspaper libeled him, and he sued the newspaper. And he won a modest symbolic settlement, which he gave away as a gift to somebody. That's one example.
There was a wonderful example, too, where I think you write about this poet Crabbe, who's at the end of his tether, and he comes as a total stranger to Burke. And Burke not only reads his poetry, but helps him revise it, gets it published, totally transforms this guy's life, this total stranger.
Crabbe is literally hungry and destitute. It's sleeping on the embankment, as it were, and pulls himself together enough to knock on the door of Edmund Burke, and Burke takes him in. Just as you say, I came to view Burke as a kind of a next-door neighbor to a saint. My friend and neighbor, Amity Schlaze, who I read the book, said, Burke is crazy and not crazy. As he aged, and his oratory became, if not more, not florid exactly, but more complex and more heavily decorated with Shakespeare and Milton and the Latin poets. The younger people came in, and he became rather an old number in Edmund Burke, and he would be greeted by coughs, organized coughing by the young folk. And he came to be known as the dinner bell, because when he rose, they left and went to the House of Commons. I guess cafeteria was not quite right, but they went to get themselves a dinner.
One of my favorite things from him is that you were talking about his willingness to take unpopular positions, and there's a beautiful thing similarly where he was often accused of being Catholic because he was a great defender of the Catholics. And there's something where he responds, and the Catholics are obviously tremendously persecuted at the time. And it says, and if, Burke went on account of such sentiments, people call me a Roman Catholic, it will give me not the smallest degree of disturbance. They do me too much honor who aggregate me as a member to any one of those respectable societies which compose the body of Christianity. Wherever they choose to place me, I am sure to be found in extraordinary good company. It's beautiful, right?
It brings tears to my eyes. It does. That was Burke at his best, and his best was fantastic. So what did they believe? So these guys were Burke and Fox were in the opposition their whole careers, basically. Each one had a short time in government, in the ministry, which meant they drew no money from the House of Commons, or unpaid. So they scrambled around for money, sometimes at rather gaming speculations and Caribbean land deals, of course, unsuccessful. So as members of Parliament, as members of the opposition, what did they believe? They believed that the king was overstepping his bounds. The king was going too far to become rather a tyrant. And they did what they could to stymie the king, but the king wound up stymieing them. So the two of them believed in the following episodes of their careers together, they believed the following. So in the American Revolution, they were both allied with George Washington and his feeble ragtag army and the ideals of the revolution against the heavy hand of Lord Martha and King George III. Now, Edmund Burke welcomed the affection of the American people, but would squash them if they had presumed to achieve power over England. He was not a friend of a risen and powerful American state, but he believed that the colonists were in the right in their disputes over taxation. But Fox, as was his kind of unchained want, he wore George Washington's colors around London, his carousings and his gambling at Brooks's Club, buff and blue. And what some people mistook his enthusiasm for the cause with treachery against, and so that was America. They both were quite stalwart members. And Murphy would say after George Washington's rout in the Battle of Long Island, let us stand by our friends in their adversity as well as in their prosperity, never abandoning people who stand for the principles of the glorious revolution of 1688 in this country, but always support them in those ideals. So that was one episode. The second one had to do with an overbearing, corrupt, and a quite cruel regime at times, quite cruel regime of the East India Company in India. And this shows Burke and his dogmatic and semi-crazy side involved the trial of Warren Hastings, who was a leader of the East India Company. And I'm not sure whether Warren Hastings was quite as guilty as everything as Burke thought he was, but the trial lasted for 8 years. And by the end of it, only Edmund Burke was interested in pursuing the case against him. And again, my friend Abbott calls this lawfare. So that shows the dogmatism of Burke and how he could seemingly be unself-aware.
It's worth dwelling for a moment on the East India Company because, as you write in the book, it was as well hated and well envied as any modern-day technology giant. And so this was the world's largest business. So Hastings, who you mentioned, was the Governor General who got impeached. Can you talk a little bit about the misdeeds and the wars and the cruelties and the scandals and the plundering of money from India? That it's kind of amazing because we talk about business now and the nefarious things that we've been saying Wall Street has done. There's a level of brutality and corruption to what they were doing that's quite astounding.
Well, all you have to know about, see behind you, William, the portraits of Charlie Munger and I guess Warren Buffett, yeah. And Charlie Munger is fond of saying, show me the incentive, I'll show you the outcome. The East India Company would send to India as employees of the firm lads of 16, 17, 18, and 20, scarcely shaving, and they would be very ill paid. They were to make their way in the company by setting up shop for themselves and by conducting their own business as a sideline. Actually, the side hustle became their focus and their main day job. So instead of enriching their employer, they enriched themselves. That's one thing to know about incentives. The other was that the East India Company was itself a sovereign. It had its own army, and it had its own merchant fleet, and its own navy. And what would a profit-seeking company do with its own military power in search of profits? It would wage wars, right?
Well, maybe the equivalent is Musk having Starlink, and maybe he's the person with the power that they had.
Yeah, maybe that's coming. But knowing those two things, you can imagine what liberties the servants of the East India Company took on their own behalf, as opposed to that interest of their stockholders, and indeed the interest of the sovereign that gave them the monopoly. So the ravaged the country. And you probably have a favorite episode of their misgovernance, but it was pretty steady and pretty heavy-handed.
Well, Clive was amazing. Clive of India. And I used to, when I was living in Belgravia in London, I would pass this gorgeous house that would say, Clive of India lived here. And you'd think, oh, this must have been some noble guy. And it's like, then you read your book and you realize, no, they were just pillaging left, right, and center. And then having plundered jewels and stuff, they would come home with just millions and millions of dollars and buy themselves respectability.
Not respectability. They would buy themselves seats in parliament.
Yeah, power.
Social respectability was, I'm not sure anyone had enough of that, but Clive of India was the avatar of the returning mogul.
Yeah.
They turned their rupees, I guess, into jewelry.
Yeah. My favorite bit that you write, well, actually, this is Burke that you quote on the East India Company. He talks about these young men, boys almost, governed there.
Yeah, right.
Without society and without sympathy with the natives. They have no more social habits with the people than if they still resided in England, nor indeed any species of intercourse but that which is necessary to making a sudden fortune with a view to a remote settlement, animated with all the avarice of age and all the impetuosity of youth. They roll in one after another, wave after wave, and there is nothing before the natives but an endless, hopeless prospect of new flights of birds of prey and passage, with appetite continually renewing for a food that is continually wasting. And just that image of these new flights of birds of prey coming in to rip off these poor natives, plundering their wealth. It's just an amazing piece of writing and rhetoric.
Now you see why I wrote the book.
Yeah. I think the book, in some ways, it almost tells me as much about you as it tells me about Burke and Fox, because it seems like it's just infused with your love of language and writing and scholarship.
It is that. But then comes the trial at Hastings to close that. Warren Hastings, the Governor General of India, as you noted, impeached. He was tried off and on, mostly off, I guess, but still over the course of 8 years. And this is an impeachment in the House of Lords. And he finally gets off. And it's most remarkable display. Okay, but there's more of that side of Burke in the death scene. And we're coming up to that now with the French Revolution. This is where these two friends parted company. I mean, it was quite irreparable. To Fox, the French Revolution that's the greatest thing that ever happened in the history of the world. Tossing off and throwing off the chains of the tyranny of the French crown and of the miserable system of aristocracy and the suppression of the lives of the people. He thought it was marvelous. Okay, that was Fox. And Burke saw in this, he saw chaos. He saw the destruction of civil society. He saw the structure of things, the order of society by social rank, very important to him, family, privilege, all this stuff, which to him was the fabric of a functional and prospering society. All this would be destroyed. The church would be destroyed. Religion itself would be trampled underfoot. And much of that indeed did come to pass with the terror. And Fox was rather chagrined by the terror. You could imagine, and put in Wall Street terms, he said, I'm really bullish on this. And then the most terrible things that happen to the company, it goes broken, and everyone's revealed to be not only an offender against the laws of the country and of the rules of the SEC, but also criminals of most horrible sort. So that's the kind of the Wall Street analog to the call that he made after the fall of the Bastille. But still, Fox clung to his view that this was a glorious moment in the history of man. And of course, he had many compeers in this. All the romantic generation then coming up, cheered him on, and he cheered them on. And okay, so that's that. But Burke was equally unmovable in his view about not only the net evil of this, but also the gross evil. I mean, he didn't see much that would come out of it except the end of France, I guess. So what about the friendship? It came to a tearful end in the House of Commons. And it was a debate over something having nothing to do with France. And Burke went on about the French Revolution. Fox said, this is not germane. And Fox quoted back to Burke some of his thoughts on the American Revolution. And Burke went incandescent over the incivility of having his own words quoted back to him. That to him was a heinous crime against the unwritten rules of the house, and more especially against the unwritten rules of friendship. And he said, our friendship is at an end. And Fox, now breaking into tears, said, no, it's not. So that was that. Time passed, and Burke's son tragically precedes him and predeceases him, and Burke falls ill and falls broke. Both of them are broke for both their whole lives. Fox lives from bankruptcy, and Burke is broke at the end. And that does nothing to lift his spirits. And as Burke lay dying, Fox reaches out to his wife, Mary, and writes, may I come and see my friend? And she consults with her husband. And she writes back to Fox, no doubt, maybe not word for word, certainly in the spirit of his reply, a very stiff reply that Mr. Burke must adhere to the views that the public knows so well, and that if he were to veer from them, it would be a great hurt to the community and to him. And he couldn't do it. So 3 eyes, Burke does. And Fox lives a long time afterwards, many years, in declining health himself. And declining health, well earned, by the way. He's so uproarious and lived. Somebody comes around to ask Fox if he would not like to contribute to a fund in collection to raise a monument to the late Edinburgh. Fox says, well, no, I can't pretend to a spirit of forgiveness such that I could do this without making a rank hypocrite. I can't. So that was that. And the book closes with Fox having finally succeeded in putting over a law outlawing the slave trade in Britain. That was what he wanted most of all. And there's a statue of Fox in Westminster Abbey depicting a freed slave or something. His freed slave that's lying on his lap in gratitude. So I say that the Fox is an enduring monument in marble, and that Burke's collected writings are a marble of another kind.
One of the things, Jim, that was so striking to me is both Fox and Burke were incredibly admirable and gifted in so many ways, and yet they were both absurdly bad with money. Both of them lived in debt. Both of them died broke. But I think Fox was kind of extraordinary. Can you talk a little bit about his gambling? I mean, the recklessness of it is quite staggering. And his father was absurdly rich. So it was quite impressive what he managed to achieve.
He comes from an interesting line, financially speaking. His grandfather, Sir Stephen Fox, was a paymaster of the forces, which meant, very briefly, that you got to invest the money that was entrusted to you for the payment of the troops until that money was needed by the king to discharge those debts. So you could do anything with it, and you got to keep the profits, whether it's interest on investing in government securities or profits from dealing in common stocks. So that was Sir Stephen Fox. And Fox's own father, who came to know as Lord Holland, got the same gig. And he became fabulously rich. People couldn't believe what he did with that money. He fed the profits to his addicted gambler. Fox would play night and day at his club, Brooks's club. He played games of dice and cards. And he was a horse player, rather better at that than cards and dice. He lost quite literally fortunes at gambling.
He lost £900 on a single game of billiards, you write, at a time when that was real money. Yeah. I think you write that in 1776, he had £140,000 of gambling debts. That's many millions in today's money, right?
Yes, and what did not speak well of his moral character didn't seem to bother him. People would say, having a sleep at night, all I want you to do is, and Fox said, well, the question is, how can my creditors sleep at night?
And it's so amazing. He would go out sort of drinking all night, sleeping with prostitutes, sleeping with his mistress, and then he would come into the House of Parliament and give an amazing speech. And I think there's a wonderful bit where Horace Walpole listens to a speech that he's just given after basically being out drinking and carousing all night. And he's like, this is just total genius, what he could do.
Yeah. People were astounded by it, but also they recognized that he was basically just a big sponge. He borrowed from his friends, borrowed from everybody, from whose father died despairing of the debts that he had accumulated and what it did to his estate. but he still kept feeding him money. Burke was different entirely. He bought lovely estate, Beaconsfield. It was, as so many lovely estates are, it was a money pit. You didn't make any more money at farming than most people do today. He was a student of scientific agriculture, but think of the productivity that he had or didn't have, how this place lost money. He could, by hitching some oxen ahead of horses and plowing, that advance, he could plow 1 acre a day. Now, today, a mechanized farmer at a not so very accommodating, hilly New York farm can do 21 acres a day, mechanized plowing. So 20-fold depreciation in plowing. Burke had 2 jobs as a parliamentarian big devil. He was a gentleman farmer, but actually more than gentleman. He was a hands-on farmer, a scientific one at that, who, with the right equipment, oxen as well as horses, could plow all of 1 acre a day. Upstate New York, we can do 21 acres a day with machinery. Not much productivity growth there. And so the place never paid for itself. It was mortgaged. So he was perennially in debt to his friends and to his political mentor, Lord Rockingham, and with all the insecurity that entails. So at length, Burke became a member of Brooks's Club as well as Fox was towards the end of his life. And one of the documents that my quite terrific research assistant and at length intellectual partner, James Robertson, managed to fish out of archives was a letter from Brooks's Club to Mrs. Edmund Burke about 8 years after his death, dunning her for unpaid dues as Brooks's.
Huh.
Oh, God. So that was the state of his exchequer. I think that Burke never suffered in his lifetime the indignity of bankruptcy. More than once, Fox's furniture was out on the sidewalk. The debt collectors came and just took his stuff. Once he was, after a night at Brooks's, after immense losses, one of his friends came to him and concerned about what this might do to him. Would he take matters into his own hands with a pistol alone in the dead of night? No. So he came, and there was Fox serenely reading some great Latin poet. His friend said, "What are you doing?" And Fox said, "Well, what do you think I ought to do? I've just lost every shilling." There was a serenity in the face of ruin that will amaze the readers of, I hope, this. I want to share one last story about Fox's death. So he fell in love with a courtesan, Mrs. Marmiston. Not ever sure whether it was a Mr. Marmiston, but they had a genuine love affair. And at length, during one of the breaks in the Napoleonic Wars, Fox takes his then wife, they were married, at length, takes her to France, and they sit down with a Talleyrand, French diplomat. And Talleyrand, too, had married a courtesan. And the two ladies sat next to each other on the banquette, and they shared very interesting observations about people they had known. Marvelous.
Before I let you go, Jim, one last question. You spent so much of your time studying history. I wondered if it gives you a sense that life has improved, that we've survived these terrible periods in the past, whether it's the French Revolution or civil wars and the like. Does it give you a sense that even in our strange and difficult moment now, that we sort of muddle through after all? Like, does your study of history give you optimism or pessimism about the future?
A little bit of both. As to the material side of life, it is onward and upward, nothing like it's ever been seen. And we would not be having this discussion except for advances in medicine. I wouldn't be your interlocutor. You have to get somebody else. The marvels with which we live are just astounding. This little thing I have in my pocket, which I forgot to put to airplane mode, has the entire canon of world knowledge. It does. And so people think, I say, yeah, what about the next edition of the Apple, whatever it is, you get jaded about these things. You get jaded about, I find myself, hear myself complaining about the pills I have to take to ward off the next round of disease. And it's in rank ingratitude. So in so many ways, things have never been better. And we should thank our lucky stars when we do. In other respects, we live back to living in rags in the forest with respect to public oratory, going back to grunting and groaning, wherever they conducted business before the perfection of writing and the arts of literacy. Can you compare what comes out of today's House of Commons, as well as, of course, Truth Social or the House of Representatives or the ultra dignified Senate. You want to lay your head down and not watch television, do something else. It's mixed. So all of the intellectual energy of Burke and Fox's time for a certain class of people was in literary pursuit. There's a great American financier called Albert Gallatin. He was the Treasury Secretary, a near successor to Alexander Hamilton. I think there was one or two between the two of them. But Hamilton was Treasury Secretary under Jefferson and Madison. And then he was a diplomat who helped to settle the War of 1812. When he came back, was a banker, and he retired. And the gravestone talks about, so he retired to pursue academic studies and literary pursuits. Gallatin did, and went down to the grave, universally honored. I go over to the churchyard from time to time and read his gravestone at Gallatin and think about him. It's marvelous. And so if you're a lover of the oratory language, you will be disappointed not to have lived in some other time. But otherwise, never mind the commonplace diseases of late life. Just go a trip to the dentist. Just thank your lucky stars,
Yeah.
But it's pretty great on balance. Pretty great. I'm glad to be here.
On that note, Jim, it's been such a delight, and I'm so happy to have got to spend this time with you. It's one of the great pleasures of having a podcast is that it gives me an excuse to hang out with you. And
awfully kind, and what a pleasure it is to be in your company. I wrote my biographies mainly about people whose company I wanted to be in. So I like your company too, William.
Thank you. That's lovely to hear. And I loved coming to the conference yesterday. So now I'm planning to become a regular.
Again.
I'm looking forward to it. Thanks so much. Lovely chatting with you.
Okay, William. Happy days.
Thank you.
Most people are only as happy as they make up their minds to be. So what this teaches me is that whatever happens in your life, irrespective of unbelievable experiences, your control of your mind determines how you end up, how you survive, and how you deal with it. And that's what people need to learn. We think about we have some problems in this life, and we have disappointments, depression, and experience, and so forth and so on. And to think that under these conditions, you can still be happy if you learn how to think and use your mind, that's pretty amazing.